What leads to such large financial losses? Perhaps lack of risk management, or poor forecasting, or implementing the YOLO strategy. Maybe it's a combination of all these things that we listed. But there is a key concept option traders should know before trading options, and that strategy is implied volatility. So, what is IV and why is it important? IV represents the market's forecast of a stock's potential price fluctuations or volatility over the life of the option. Essentially, IV reflects the market's expectations for how volatile the underlying stock will be in the future. In other words, high IV indicates greater uncertainty or significant expected price movements. This often happens around major events like earnings announcements or geopolitical events, while low IV suggests less uncertainty and smaller expected price swings. Okay, but how does this help us? Well, let's consider through an example. Let's say we have two stocks. Let's also assume that all the attributes between the two stocks are the same. Both stocks are at $100 per share. Which stock would have more expensive options? Stock A has an IV of 20. This means that the market expects stock A to move positive or negative 20% within 1 year. We can also convert IV into monthly or weekly metrics by performing the following. We have a price range formula, which is the current stock price multiplied by IV and then multiplied by the square root of time period. For the annual price range, the time period is 1 because we are doing annually. For months, we would do 1 divided by 12 for the time period. And then finally, weekly price range is 1 over 52. Now we see the price ranges the market expects stock A to be at within 1 week, 1 month, and 1 year. Stock B, however, has an IV of 100. This means that the market expects stock B to move positive or negative 100% within 1 year. An IV of 100% reflects extreme high volatility, often associated with significant uncertainty or major upcoming events. So, which stock option would be more expensive? Well, stock B's option would be more expensive compared to stock A because the IV suggests traders expect the stock to swing, making options for such a stock like stock B significantly more expensive. These swings in price increase the likelihood of the stock moving into the money and passing the strike price, especially for out of the money options. Might think, okay, so my likelihood of making money increases if I buy options from higher IV stocks, right? Well, not exactly. It's actually more ideal to buy options in stocks where the IV is currently lower relative to its historic volatility. If we assume the law of averages, then we predict the stock's IV to rise as it returns towards the mean. An increase in IV increases the value of both call and put options because the IV is the expected volatility in both directions. Okay, so how can I figure out the current IV and the historic volatility of a stock? We can Google a stock ticker followed by implied volatility and click on Market Chameleon. Their overview tells us the current implied volatility along with the 20-day historic volatility. For example, Amazon's implied volatility is currently at 35.9, which is 11% above its 20-day historic volatility of 32. Amazon's volatility may come down in the near future because of the law of averages, causing call options to decrease in value even if the price stays the same or slightly increases. Okay, so hold up. So even if Amazon goes up, my call option could still drop in value? Yes, Let's say you buy an out-of-the-money call option on Amazon stock. The value of an out-of-the-money option comes from its intrinsic value. Extrinsic value is the value attributed to time until expiration along with volatility. If IV drops, then the extrinsic value of the option also drops, even if the stock is rising. If the IV drops, the intrinsic value outweighs the gain in intrinsic value, the total option price can go down. If your option is in the money, then the option at least has some intrinsic value, which is the amount the option is in the money, which is stock price minus the strike price for the option. If there's a sharp decline in IV because of a significant market event, then the option's intrinsic value will drop with it. This is also known as IV crush.
You should have gone for the head.
This drop often happens when a significant market event that the market was anticipating, such as an earnings report, economic announcement, product launch, or other major news occurs. Since implied volatility heavily influences the extrinsic value or time value of an option, a rapid decrease in IV can lead to a substantial loss in the option's price, even if the stock price moves in the expected direction. This is what makes IV so important. You may be right in the stock's directional movement, but the option you bought was inflated in value because of heightened IV. Sometimes IV is already pricing in 100% upsides or downside moves. So who benefits from higher IV? Option sellers benefit from higher IV because they get to collect premium on bloated option prices that are already pricing in large stock movements. If you're curious about how to sell options, check out my playlist on option trading strategies in the top right and in the description. So on the flip side, who benefits from low IV? Well, here option buyers benefit from lower IV because IV may return to the historic volatility average, which increases the option price. The market may be undervaluing these options if the market does not properly calculate the implied volatility of a stock. Remember, IV is not certainty, but rather the collective market expectation of future stock price movements. Hope this video clarified implied volatility and its importance when trading options. If you want to watch more option-related videos, check out my option strategy playlist to continue watching in Trendias. Thank you all so much for watching. Make sure to subscribe and like the video if you found this helpful. I will see you all in the next one.
I don't feel so good.
You're all right.
I don't know what's happening. I don't know. Hurry. I don't want to go. I don't want to go, sir. Please. Please, I don't want to go. I don't want to go.